Hi, welcome back to this course on infrastructure finance. So far we have looked at some of the basic concepts related to financing of projects. We have not specifically discussed much in terms of what are the specific trends that we actually see in financing of infrastructure projects. What we have broadly seen is some of the basic simple concepts related to financing of projects. We have looked at the time value of money, the cost of capital, and we also looked at some examples of capital budgeting, and in the capital budgeting we have actually looked at an example of an infrastructure project as well. But when we talk about infrastructure finance, there is something very specific that is normally meant about what do we mean by infrastructure finance, and in this lecture and in the following few lectures we will specifically talk about some of the basic techniques that is used in financing of infrastructure projects. Again, I would like to re-emphasize that when you are talking about infrastructure finance in this course, we are specifically talking about private financing of infrastructure projects. So infrastructure projects that are normally funded by the public sector is not going to form a major part of the discussion of this course, and we will restrict our focus to largely private financing of infrastructure projects. And when you are talking about private infrastructure financing projects, broadly we can look at financing into two categories. The first is corporate finance, and second would be project finance. And in this lecture we will specifically talk about trying to understand the major features of these two modes of financing and the differences between the two modes of financing, and we will spend substantial part of the time in discussing project finance, because project finance is the format, the structure or the technique that is used in financing of infrastructure projects in a very common manner. Okay, let us get on. Okay, let us quickly do a roundup of corporate finance. If you really look at corporate finance, that is essentially how do companies make their financial management decisions. So corporate finance is nothing but how do companies make their financial management decisions. If you really look at there are broadly two types of two sources of funds, equity and debt. Equity is the capital contribution by the owners, and debt is the capital contribution by the lenders. So in most circumstances the owners would not be able to make the entire contribution or that the investment needs, and therefore they will put part of their contribution as sponsors capital, and then the remaining that is borrowed will be debt capital. So consequently we also have two kinds of investors in a company, the shareholders and the debt holders. The investors who are invested in the equity are called as shareholders, and the investors who have provided debt are called as debt holders. And it is very important in the world of finance to really look at how the different investors get returns. So for example, an investor would expect a return for investing in the project, and he will also expect the return of capital that is actually invested in the project. So the profit in essence on the investment is the return that the investor makes, and it is very important that we understand the sources of return for both the types of investors. So if you look at debt holders will actually get interest on their investment. So in that sense the interest that the debt holders get is the return on their investment, and at the end of the loan term the company would also give the repayment of principal, so that is their repatriation of their original invested capital. So debt holders will get interest on their interest, will get return on investment on their interest, and the capital will be by way of principal repayments. Now if you look at shareholders, how do the shareholders get their returns? Because shareholders do not get any interest, but shareholders get what is called as share in the company's profits. So the company's profits largely are distributed to the shareholders by way of dividends. So the returns to the shareholders are by way of dividends, and whenever the shareholders get to sell their share to another investor or back to the company, they get a return of their capital. So the way in which the return comes to both the investors are very different. In the case of interest, the interest is contractually guaranteed by the company when it borrows, but as far as dividends are concerned, dividends are paid only when the company makes profits. So therefore dividends cannot be contractually guaranteed, and dividends are paid only after all the other obligations of the company has been serviced. So to that extent the shareholders get only residual payments. So there is also a difference in terms of when do the investors get returns. Debt holders get seniority in getting returns. So for example, debt holders are paid first before the equity holders can be paid. So therefore they have what is called as, in the sequence of payments that actually happen to different investors, they have seniority as compared to the equity holders. The shareholders, as we have just mentioned before, the shareholders get only the residual payments after all the other obligations of the firm has been met, and for some unforeseen reasons, if the firm gets into bankruptcy, then the shareholders are eligible only for the residual payments after the lenders and other investors in the company has been paid. So this is largely what is called as your corporate finance. Now let us look at it in an illustrative way. So what happens when a firm actually identifies a project? The firm has actually identified a project, let us call it project 1, and this project 1 is funded by a mixture of equity and debt, and how much of it is debt and how much of it is going to be equity, it depends on several things. It depends on the project, it depends on the industry, it depends upon the kind of the revenues, the certainty in the revenues that we actually see in the project, but nevertheless we can assume that each and every project, let us say, is get funded by a mixture of debt and equity. Now if the company is being able to identify another project, let us call it as project 2, and obviously when the company needs to make an additional investment, it needs more capital, so therefore the company expands its existing base of capital. So what happens is the company raises additional equity, the company raises additional debt to meet the investment requirements of the second project. So what you actually see here is you have project 1, you have project 2, and the company is implementing both in the same structure. The capital base is expanded, but then it is not really separated in terms of capital structure as two different entities. Now let us say, for example, there is another project, we call it project 3, and if the company wants to implement this project, then the company needs to further enhance, expand its capital base. So that means the company would actually raise an additional equity and additional debt. So this is a very fairly simple way of looking at funding a project. So many times what happens is the project 1, project 2 or project 3 need not always involve issuing of fresh capital. See, for example, if a project 1 is profitable, then the company need not pay the profit in terms of by way of dividends, but in turn they can retain all the profits and then use it as an equity investment in project 2. Similarly for project 3, if the first 2 projects have been generating profits, then the company can retain the profits within the company, not distribute it as dividends, and then use the retained profit to meet the investment requirement of project 3. So not always any new investment would involve raising of fresh capital from outside investors. So when I say outside investors, investors who are not part of the existing firm, and you will have to probably bring in new investors. So that is what we mean by outside investors. So now let us take the situation that unfortunately you have let us say for some unforeseen reason there is one of the project failed. Let us say for example project 3 has failed. So there is project 1 and there is project 2, they are doing very well, but if there is a failure of project 3, then the company who has raised certain amount of capital for the purpose of investing in project 3, then those investors who have, particularly those investors, the debt investors who are invested for the purpose of project 3, they will have to be repaid from the cash flows of project 1 and project 2. So just because a particular project has failed, the equity holders, the investors in that project need not necessarily suffer. So this is essentially the principle of corporate finance. So if you really look at it, even if there is a failure of a particular project, the cash flows from the other projects, other profitable projects of the company would be used to service the investors of the company, because essentially if you look at it, the company might have actually raised money for a particular project, but then the investors are not looking at only the project to service their investment. The investors are looking at the cash flows of the company for servicing their investment. So therefore, even if the particular project fails, the cash flows from the other project are expected to service the requirements, the return requirements of the investors. Now let us look at project finance. How is project finance different as compared to corporate finance? So in a project finance, like we have in corporate finance, there is a project, and then the project actually has certain amount of equity and debt, and then the equity investors are the equity shareholders, and then we have debt investors. So this is a project that is being implemented. Now there is another project, and the company is actually found as a project 2 which is profitable, and so for financing this project 2, the company would actually raise an additional amount of equity and debt, and they could be from equity shareholders, the same shareholders, or it could be different shareholders, but necessarily this project 2 involves a separate class of equity and debt being issued. So for example, if we have another project, project 3, then this project 3 is being funded by equity and debt, which again involves another set of equity shares and debt being issued. So in essence, if you look at it, all 3 projects are all separate entities. They are not part of the same corporate structure. So an investor who is actually invested in project 1 is looking at only the cash flows from project 1 to service their return requirements. An investor invested in project 2 is looking at only the cash flows from project 2 to service their return requirements, and so on. So therefore, when we have a situation that if one of the project fails, let us say for example, if project 3 fails, then the investors who have invested in project 3 will not be able to get a return or recover their capital that they have invested in this project, simply because of the fact that project 3 is actually incorporated as a separate entity, and the lenders or the investors in the project will look at only the cash flows from project 3 to service their requirements. Project 1 is a separate company, project 2 is a separate company. These are all individual ring fenced entities. They are not part of the same corporate structure. So project finance is nothing but financing of individual projects, and since these individual projects by themselves are individual companies, then the investors in this project will have recourse to only the cash flows of the project and not cash flows to the corporate structure or to the cash flows of other projects under the same corporation. So let us identify some of the major features of project finance company. Point number 1, each and every project is established as a separate company. So each and every project would, when we actually look at a separate company, each and every project would have its own financial statements, it have its own set of shares being issued, it have its own set of lenders, and so on. So we actually have a company whose objective is clearly defined, which is to actually operate and develop only the particular project for which it has been set up. So now if you have, let us say for example, an additional project, an additional investment opportunity that emerges, then how do we actually do it? So then what happens is the parent company or the holding company will actually have to set up another company, and the specific purpose of the new company would be to implement the new project, develop and operate the new project. So a major characteristic of project finance is each and every project is established as a separate company. Point number 2, major portion of the project equity is provided by the sponsor. See, for example, if you look at it, equity investors can be broadly classified into two categories. We have what is called as your active equity investors, and then you have what is called as your passive equity investors. So active equity investors are those who actually take major decisions with respect to a particular company. For example, in the case of a power project, it could be like what should be the capacity of the plant, what kind of technology should be used in setting up of the plant, what kind of fuel should be used, and what type of equipment should be actually used. So essentially the set of decisions in major decisions pertaining to the operation of the company are done by the active equity investors. So active equity investors are those that are actually promoting the project, and so they are also called what is called as your sponsors. They are called as your sponsors. So a major feature that you actually see in project finance company is major portion of the equity is provided by the sponsor. So out of the entire amount of equity capital that we actually see in the company, majority of them is actually provided by the sponsors. So passive equity investors are actually providing only a minor part of the capital. The third feature that we actually see in a project finance company is the project finance company operates with a high ratio of debt equity. So that means we are saying that the leverage of the firm is going to be very high. So when we really look at it on an average, if you look at all the companies in this universe and find out the contribution of debt equity ratio, then you actually get a figure something like 1/3. So out of the entire amount of capital invested in all the business, 1/3 of it is by way of debt, the remaining 2/3 of it is by way of equity. But if you really look at companies that are using a project finance structure, at a very broad level, you find 2/3 of the entire capital is by way of debt, and the remaining 1/3 by equity. So you generally find in a project finance company substantial amount of capital is by way of debt rather than equity investment. So this is a third important feature. You will rarely find a project finance structure, and there are sound reasons as to why it should be the case, which we will also see later towards the course, that project finance, you will rarely find a project finance company which is funded entirely by equity or substantial part of the company's investment by way of equity. Most of the investment is by way of debt. And the fourth major characteristic that you will find is there is comprehensive contractual arrangements with various stakeholders of a project. It could be suppliers, it could be customers, it could be the government, and so on and so forth. Okay, so this contractual agreements is a very important feature and plays a very prominent role in the case of project finance company. So let us look at some of the contractual arrangements that you will see in a typical project finance company. So this is an illustrative slide. So you have what is called as your project company. So project company, it's also denoted by several other means. For example, a very common nomenclature for a project company is also called as a special purpose vehicle, and we also tend to use this fairly interchangeably, project company or special purpose vehicle or SPV. So, project company is also known as non-recourse financing or limited recourse financing. So, these terms that we actually see, we will be using it fairly interchangeably. So, there are very small nuances between let us say limited recourse and non-recourse, which we will understand as we go along, but by and large these are used normally to denote what is a project finance company. So, in a project finance company, let us say for example the most common contractual arrangements are, let us say there is a contractual arrangement with the customer. So, in the power purchase in a power plant there is a power purchase agreement. So, the power purchase agreement is a contractual arrangement with the customer which kinds of specifies like for example what will be the price at which the power will be purchased by the customer, how much of power will be purchased, and for how long will this agreement be valid, and the power purchase agreement will also specify other conditions like what will be the number of days in which the plant will undergo maintenance in a particular year, and so on and so forth. So, there is a very strong contractual arrangement with the customer. And then you have what is called as your lenders. So, lenders the agreement between the lenders and the project company is called as a lenders agreement. So, the lenders agreement will specify among several things the conditions with that are associated with the loan, what are the kind of compliances and covenants that the project company will have to meet during the term of the loan, and so on and so forth. And then you have an arrangement with the sponsor. So, the arrangement with the sponsor and with the company, it is called as your shareholders agreement, and this actually specifies the various features related to the shareholding investment by the different sponsors in the project company. And then you have what is called as your suppliers. So, there could be various suppliers who will actually play a very important role in uninterrupted functioning let us say of a power plant. So, in a power plant, if you look at it, you need to actually have an uninterrupted supply of fuel for the plant to operate. So, the project company will have to sign what is called as a fuel supply agreement, that is an FSA with the fuel supplier. So, the fuel supplier the fuel supply agreement with the fuel supplier will clearly mention what will be the amount of fuel that will be supplied, and what will be the kind of price estimated price of this fuel supply. It will also mention the quality of the fuel that will be supplied, and so on and so forth. So, unless until there is this kind of an agreement, the power plant is going to be exposed to a lot of uncertainty in terms of the availability of the fuel. And then we have an arrangement with the contractors. So, there are for example various types of contractual firms who may be providing service to the project company. So, there could be the maintenance, equipment maintenance, and so on. So, for example, most of the time there has to be periodic maintenance done for the power plant. So, since these are all not regular activities, most of those activities can be outsourced. So, there will be contractors and there will be agreements with these contractors who will provide such outsourced services as maintenance, and many times you actually also find situations where the operations, the regular operations, are also being outsourced. It could be to other firms that are specializing in such operations. So, when you have these kinds of outsourced services, you actually have an operating agreement and so on. And during the project development phase, there are also other related activities. For example, you will have engineering, which is to really do the designing and development and all of those things. So, those kinds of contractual services, there is an agreement, and then there is procurement, procurement of materials, procurement of equipment, you have testing and all of those services, which again is kind of an agreement. And then you have construction many times you will have to actually have substantially a lot of construction activity involved in these kinds of projects. So it is done by specialized construction firms. So you have what is called as your construction agreement. Most of the time these are all bundled together, engineering, procurement and construction, they are called as EPC contracts. So EPC is a very important part of the contractual agreement that exists between project finance company and contractor. Similarly, you also have let us say in addition to fuel supply, you also have an equipment supplier. An equipment supplier is supposed to supply equipment of appropriate standard and quality to meet the engineering and design requirements. So that is again you have an agreement with the equipment supplier. And finally, you have some kind of a contractual arrangement with the government. So in many cases infrastructure projects are actually involving so many other actors such as the environment, such as roads and land and all of these things. So these are all domains that normally come under the government. So the government usually gives a license, the government gives a concession for the project to operate. So this is an agreement that we actually have with the government. So for example, today if you really look at it, government gives a license for the telecom companies to operate, right. So that is an agreement between the government and the project company. The government gives a concession agreement to the private airports. The concession agreement clearly specifies for how long can the private operators operate the airport. So that is a concession agreement. So sometimes the concession agreement is of a permanent nature, but sometimes this actually have a fixed lifetime. So in the case of a toll road, the concession agreement also has a fixed lifetime. But there are several other cases where the concession agreement is more of a permanent nature. So this licensing or a concession agreement is the contract between the government and the special purpose vehicle. So if you really look at it, you will find a project company is associated with a very strong contractual arrangements with various stakeholders. So the question that you have is why is this contractual agreement an important part? It is an important part of any project finance company, because unlike you have it in a corporate finance structure, here the lenders and the investors to the project are only dependent on the project cash flows, and only if the cash flows occur from the project they will be able to get returns and repatriation of their investment. So it is very important for the cash flows to be reliable, it is very important for the investors the cash flows are certain, and for that to actually happen the various stakeholders that are involved in ensuring that certainty has to be more or less kept in place. So you have this kind of watertight contractual arrangements. This ensures or reduces the uncertainty that are associated otherwise. So you have this kinds of extensive contractual arrangements simply because of the fact that the investors in the project would like to assure or reduce the uncertainty of the cash flows, and these contractual arrangements is a way of mitigating some of the uncertainties that might exist otherwise. So now let us look at a situation where, let us say, the company does not have any agreement with the customer. So that means in the case of a power plant there is no power purchase agreement. So when there is no power purchase agreement, we are not very sure as investors how the project is going to get its revenues. The revenues could be there, and the occurrence of these revenues depends on so many other factors, but if you have a power purchase agreement there is very clearly available contractual relationship with the purchaser which indicates that so much of power generated will be purchased by the customer at such and such price. So, this reduces what is called as your demand risk, this reduces what is called as the market risk of a particular project, and having a power purchase agreement will give a lot of comfort for the lenders as well as the other equity investors in the project. So, the reliance only on the project cash flows is a major reason why we have such extensive form of contractual arrangements in the case of a project finance company, and it is very important for us to realize the fact that unless until we have this contractual arrangements in place, we may not really have a successful project financing closure, simply because the investors will not make an investment without these kinds of extensive contractual arrangements. Okay, now let us really look at is project finance really a new thing, or how has it evolved over a period of time, and so on. See, for example, if you really look at it, project finance is not something that is an offshoot of modern management practice. In fact, there are evidences that this method of financing has been used even as early as the 13th century, but it might not have been known by the name of project finance, but essentially the principle of using cash flows from the investment to service the requirements of the project lenders was something that was prevalent for a long even centuries ago. But the dominance of project finance has been largely attributed to let us say from the 1990s onwards, because it is only during this time there has been substantial amount of private sector capital flowing in sectors like infrastructure. Now, most of the time before that, predominantly world over, the funding has been largely by the government for infrastructure, and such government funding for infrastructure does not really put in place any major requirements of sound financing structures. It is only when we actually involve private sector financing there is a need for much more robust analysis of having sound robust analysis and the need for having sound financial structures. So, consequently, the development, the growth of project finance happened from the 1990s, when there has been a worldwide trend of, let us say, deregulation, privatization, liberalization, and opening up of infrastructure to the private sector. And this is the phenomena that we see in a particular group of countries, not necessarily we actually see project finance or privatization of infrastructure happening in both developed and developing countries. So, you have today among developing countries like India, you have substantial amount of countries in Latin America are all attracting private sector capital, and they are dominating project finance in developing countries. Same, we also find private sector investment in infrastructure in some of the developed countries, notably you find the UK, you find Australia, where you actually have private sector investment happening in infrastructure. The second major reason for the growth of project finance is what we call as internalization of investment in major projects. Earlier, most of the investment used to be by way of domestic capital. Whatever investment used to happen, international investment used to happen, it will be used largely from the multilateral agencies as far as developing countries are concerned. But today, private investors are willing to invest in infrastructure projects in developing countries. So, no longer are we dependent only on private sector capital, and that too private sector domestic capital for financing these infrastructure projects. So, you find broadly there is substantial internalization, there is a lot of global investment happening in developing countries projects as well. And when such global investment happens, we need to really have a structure that can actually support these kinds of international investment, and project finance is seen as one such mechanism which can actually support these kinds of international investment in infrastructure projects. So, therefore, the growth in project finance can be attributed to two things. One is there is from the supply side there is a lot of overseas capital that are interested in investing in projects in developing countries, and then there is a demand side. There is a lot of private sector capital needed for developing infrastructure projects, particularly in developing countries, and these two trends were a major reason why we see project finance being implemented in a very dominant way the last 20 years or so. So there are various numbers that actually are being indicated in terms of seeing how much we have seen private sector investment in project finance and how much of it by way of project finance and so on. So if you really look at it, there are estimates. For example, as early as 2001 there is about 133 billion of project finance loan commitments that has happened, and in the 5 years prior to that, so in 1996 the commitment was only 47 billion, but in 2001 the commitment was 133 billion. So in a span of 5 years the commitments have increased about threefold. So this indicates a substantial amount of growth that we actually see in project finance, and you also see that most of these are targeted towards infrastructure sector. So for example, if you look at it, power sector and telecom sector has been major beneficiaries of this growth in project finance. Most of the projects in these two sectors are actually implemented by a project finance structure. So over a period of time there has been trends that have actually expanded the frontier of project finance. So if you really look at it, in the 30s to the 70s, the project finance was largely seen for natural resource projects such as mining, oil and gas. Those were investments that involved a substantial amount of risk, and whenever there were a private sector investment in these kinds of projects, most of it is actually on the basis of project finance, where the cash flows from the project were the only recourse that the lenders had, so that they could get the returns on their investment. But as more and more infrastructure projects sectors were being thrown open for private sector investment, then we actually saw such project financing structures being used in other sectors as well. For example, in the power sector, when we had the concept of independent power producers emerging, the independent power producers were actually funding their plants using a project finance structure. So we have started with natural resource, then we started power, and then subsequently we also looked at other public infrastructure like roads, public buildings, transport. As more and more infrastructure sectors were being thrown open for the private sector, project finance structures were being used in these sectors. So in 1990s, when there has been literally a revolution in the telecom industry with the emergence of mobile telephony, we have also seen many of this mobile telephone being actually done on a project finance basis. So to quickly kind of sum up, what are the key features of a project finance? It is provided for a ring fence project. When you say ring fence project, the only purpose of the project is to operate that particular asset, that particular project for which it has been set up for. It is separate both by legally as well as by other means from the other projects that the parent company or the holding company might be incorporating. So the project is through a special purpose legal entity, so it is not a division within a company. So for example, if you really look at it, many large companies have divisions. So one division will actually be let us say, for example, for a particular line of business, another division for a different line of business, and so on. So today you have let us say, I knew of a company called Imperial Chemical Industries. So the Imperial Chemical Industries, they had different businesses. So it had a business for paints, it had a business for rubber chemicals, it had several such businesses. So each of these businesses were considered as separate divisions, but they were all under the same company. The divisions were not separate legal entities, but in the case of infrastructure projects, these divisions are not just entities within the larger company, but these divisions are separate legal entities. So today if you really look at let us say a company like GVK or GMR, which are some of the leading private sector companies in infrastructure in India today, you will find several different companies under each of them. So for each and every project that they are implementing, there is a special purpose vehicle that has been created, and this special purpose vehicle is a legally separate entity. So for each and every project is not created as division as a parent company, but it is created as a separate company with a separate legal entity. And the only business of the special purpose vehicle is a project. They can't go ahead and acquire business, they can't go ahead and expand to a related business, they can't actually go ahead and expand the capacity of the existing business unless until that has been originally mandated, and so on. So the only business is to operate, develop the project for which it has been set up for. So usually it is project finance is created for an is for new project rather than for an established business. You don't really find when somebody wants to acquire an existing business that is established, you don't find deployment of a project finance structure, but when you actually setting up a new project, it is that time when you set up as a project finance structure. And we have also seen that this project finance is featured by a high ratio of debt to equity. Sometimes debt may cover as much as 90% of the cost of the project. And we also talked about two concepts, limited recourse and the non-recourse. So non-recourse essentially indicates that the lenders to the project do not have recourse to the cash flows of the sponsors. So for example, if there is a sponsoring company like GMR and it is created a special purpose vehicle for, let us say, implementing a toll road project, the investors in the toll road project do not have recourse to the cash flows of a parent company like GMR. So that is called as your limited recourse financing. Lenders' recourse is limited to the cash flows of the project at which they are investing. So that is a limited recourse. And a related term is called as non-recourse. I beg your pardon, non-recourse is what we have just mentioned. The lenders do not really actually have recourse to the cash flows of the parent company. What is limited recourse? A limited recourse is lenders have recourse to the sponsor's cash flows for a limited duration. So what is this limited duration? When the project is being constructed, when the project is being developed, till the time the project starts earning its cash flows, then the lenders will actually have recourse to the cash flows of the sponsoring company. But the moment the project commences operations, then the lenders do not have recourse to the cash flows of the sponsoring company. So therefore there is a time till which the lenders have rights to the project to the cash flows of the sponsoring companies. So this is called as your limited recourse, limited in terms of time, limited till the time the project commences operations. Remember, the project can actually fail for even issues pertaining to the construction phase, the project development phase, and so on. So at the time the lenders make an investment in the project on the basis that the sponsors have the capacity to actually develop and construct the project so that it can begin operation. But if the developers or the sponsors are not able to meet that, then they will have to satisfy or ensure that the lenders get their capital back. So till the time the project begins operations, the lenders are making an investment on the basis of the sponsor's strength. So therefore they are able to get recourse to the sponsor's cash flows should anything happen to the project. And we also see that in traditionally lenders have recourse to what is called as the assets of the project. Should anything happen to the project, the lenders can seize the assets, liquidate them, and then recover their capital. So the value of the underlying assets or the collateral security that the lenders expect to get plays a very important role in the lending decisions. But as far as infrastructure projects are concerned, the market value of the assets in place are not substantially high, in the sense that the lenders cannot easily liquidate the assets. First is there are several restrictions by which they may not be able to seize the assets and liquidate them, and second, the assets are very specific in nature, and there are very few users, very few alternative users, and therefore the lenders will not be able to realize much if they are going to liquidate the assets towards interest or debt repayment. So therefore, more than the value of the assets in place, the value of the project is dependent on the strong contractual arrangements as well as the future cash flows that such contractual arrangements bring in. So the lenders mostly look at the future cash flows rather than the existing assets. Normally lenders also look at historical performance of the company, but since we actually have project finance only for new entities, we do not really have historical financial performance. So the common things that lenders look at, historical financial results as well as assets in place, may not be such a great feature in the case of project finance. What actually is going to be valued in project finance is the strength of the future cash flows. Okay. So we will stop here.